This is a webinar for our builders, tradies, etc., those in construction running a business in construction already and looking to start taking on their own property development, or already doing that kind of activity and looking for ways to, I guess, make sure that they're in a better position at the end of the day from a margin perspective, an outcomes perspective. That at the moment can't be done without one eye on what's happening with tax reform and the federal government wanting to, I guess, play around with our tax system. So we're going to be talking about that today. I'll introduce our other hosts today. So we've got Suzanne Crichton, who is one of our partners in our compliance, otherwise known as, well, we call it compliance team, but really it's tax and structuring and all that good stuff. So welcome, Suze. And also Josh, who is also a partner in that same team. So we've got two partners here, real experts in the field. We are, as a firm, we really just do building and construction. So these guys understand tax and property development, structuring and the like, really through that specific lens. So we're very grateful to have you guys here today, Josh and Suze. Just before we get going, a few housekeeping items here. As you probably know, some of the aspects of what we're going to talk about today are still in question. So we're still waiting on full legislation on the discretionary tax, family trust legislation. So we're still waiting for that. So there are some question marks with some of the content we're going through today. If you want to put your questions into the chat, as we can see, that's working. So please drop them in there and we'll try and respond to those as we go. We actually have heaps of content to get through today. So we might not be able to do our usual stop and answer a question along the way and talk through the response. If we don't get to your question, that's okay. We are going to be releasing an FAQ at the end of this as part of the video follow-up as well, so that any of the questions that we weren't able to get to and answer in the chat, we're going to send out responses to all of it after the session today. There's a couple of polls so that we'll be sort of seeing where you're up to, and there's also a poll at the end. If you wanted to set up a consultation with us, that's the way we like to do it. You can just press the button on whichever service you want a consultation on, and we'll be in touch with you after the event. And also just wanted to mention as well, we have some more events coming up as well, so we'll talk to that at the end. If you don't know us already, we have a range of different services, again, all delivered with building and construction in mind. We're not, all things to all people. We just do building and construction. Josh and Suze, as I said, are in our tax and compliance team. So you should understand, I guess, it's a fairly standard kind of accounting service that everyone should have their head around. Bookkeeping is an outsourced service. That is all about accurate and timely data, having a team who can make your bookkeeping more efficient, and they really understand all of the different all the different software that's in play in the market, and can drive that software really well for you so that you've got some good efficiency in your workflows. Financial control and ScaleX is all about having reliable data in front of you when you're making good decisions. So that's a fractional service. It's a bit like having your own financial controller or CFO in your team, but on a fractional basis. So they're the services we provide. I'll just go into now the agenda. So what we're going to be covering today. So a bit about the intent and the business model, and that's really important. When you go into property development, you need to be clear on what your plan is. Are you going to be sort of treating this like ongoing business and flipping projects regularly, or is this something you're going to hold for the long term? We'll then go through feasibility, how to work out whether a project makes sense. We'll cover off on the tax reforms piece, structuring, some 101s around best ways to structure, including joint ventures, if that's something you're considering, finance, and then finally a piece on this might be a good idea, but are you actually ready to take on something that is higher risk in building and construction? Property development is a higher risk profile, so are you ready to take on that sort of activity? So I will just, before we get going, a disclaimer. So please, this is very important information we're going to cover today. It really is just general information. So please make sure you talk to a lawyer, a specialist accountant before you make any decisions based on what you've heard today. So a quick poll to get us going. So we are interested to know where you're at in the journey, and whether you're just starting out or whether this is something you're doing all the time. So drop that in there just so that we can kind of all get a bit of a sense of where the audience is at in their journey. So where are you at in property development? Maybe you've just done some renos on your own house, having your first crack at a development, have been doing some small developments, but starting to scale up, getting pretty serious. More than half my income for the business now is coming out of that activity, or you're a full-time developer and this is all you're about. So good to get a bit of feedback there in terms of what the audience composition is. So it looks like most people are, either doing their first development at the moment or have been doing some development and getting ready to go. But we do actually have a decent kind of spread across the whole suite. So I'll just share that with you there. So we can see there that, yes, most people, third of the people on the call are either doing their first development or have been doing some small developments and I guess wanting to step up a little bit now. So that is the room we're in today. So we are going to hand over to you now, Josh, and we're going to talk through intent. This all-important initial question around what are we going to be doing from a property development perspective? Are we holding it or are we doing this development to sell? Over to you, Josh.
Thank you, mate. Bill and I will do a bit of a talkback radio style through this as well, so enjoy that little approach that we'll have. Now, this part early on, particularly those who were having their first crack, it's a bit of a crystal ball moment on intent to a degree, but that doesn't necessarily mean you need to know your pathway with perfect sort of clarity out of the gate. So when we're in property development, so we're not talking about investment properties necessarily here in the ordinary sort of hold and get rental income. Now, we're really looking at intent in the development lens, and you've got two directions you can go. You're either doing a project to sell it and get profit out of it at the end, or you're developing it with a prospect that maybe holding on to it as a long-term might be a good idea, or at least holding for a period of time to possibly re-leverage it. So that decision, interestingly, does drive most of the rest of what we're going to talk about today around structuring, how we deal with tax implications, etc. And so it sort of comes into, rather than going into a project somewhat hoping to see what happens, it's having a decent idea of what your sort of destination is. And generally, you'll have an idea where you're landing on it. A lot of the time we see, particularly the phrase flippers and all that sort of stuff, clearly that terminology is indicating we want to sell it, which is actually most of what we're talking about today and where most people are actually landing in this space. So having a good think about what the destination is really important up front, because that helps the likes of Susan and myself also help work out how we're going to structure these sort of projects as well. So once we've sort of got an idea, before we go diving in, buying land and kicking off a project, there's the concept of actually understanding the feasibility. So we might transition into that piece now, Phil, around the the feasibility. And so there's a few sort of elements that go into feasibility. Now, there's two elements. We need to have some, rose-colored glasses to identify opportunities, but we also need to sit back and go, whilst it looks like a lovely opportunity, does it actually make sense? And so feasibility is not just pure financial, but it's feasibility from a number of different areas as well in terms of capacity and all those sort of things. But we'll focus on financial feasibility here. So there's the core elements that are going to go into this in terms of feasibility. Obviously, there's the core financial elements of it. So what's it going to cost me? What am I going to sell it for? Does that differential actually make sense? And we'll talk about that in a minute. Also need to understand timing of these projects. When are we going to do it? How long is it going to take? And we might touch on just a little bit as well. In timing in the context of development can be longer than you think, particularly when you're dealing with councils and needing to actually get development approval and DA. And then the big overarching one is how are we paying for this development? And 9 times out of 10, particularly when you're starting out, you're not just throwing a whole bunch of free cash at it. We'll be borrowing money, and there's a few different ways that we can borrow money. Now, to sort of help our people sort of think about financial feasibility, we have actually got a feasibility tool.
Yeah, I just wanted to, just before we move on to talking through the tool, this isn't just a beautiful PowerPoint set of circles interconnected. They're interconnected for a reason, Josh. In a way, we could draw lines across all of those points, because when we talk about a feasibility model, it isn't just, we do this, like it's not necessarily a straight sequential piece of work.
That wouldn't be nice.
Each of these factors will influence each other independently, and there's a lot of that interactivity going on. So obviously, the simple one would be timing and sale price. Depending on where the market's going, the sale price will have to factor in what a forward-dated sale price is going to look like. Finance costs and, pre-construction costs. Quite often, people underestimate that initial phase in terms of pre-construction and what they're going to need from a financing perspective at that point of the journey. And so really each one of these factors is going to determine the outcome for the other factors that are in play. There's this sort of push and pull that's going on all the time. So I might just flip over now to the model so we can start talking that through, and people will be able to see, I guess, how that starts to play out.
Yeah, and you'll see how they interconnect as we go along. So just for ease of looking at this, Phil, do you want to launch our orange boxes for focus on this as well? So you'll see how this tool, which is available from our website at any time.
And we'll be sending it after today as well, along with the video. So we'll send you a link to this feasibility tool. It is a spreadsheet. We're just showing you the screenshots rather than going to an actual spreadsheet today.
Exactly. So the blue fields in the spreadsheet are the sort of input fields. I've just highlighted in green today the ones that I sort of wanted to focus our attention on, which covers off on that visual just on the previous slide. So in terms of time, we need to be putting things in this model that really do take into account. So this is just an example. It doesn't necessarily show exactly how it'll play out, but things like lead-in time, clearly construction time frame is a really big factor in this as well, and also at the end of the project as well. So once you've finished a project, you've PC and it's all ready to go, it doesn't necessarily mean that the day after that it's sold. So we need to have lead-in time and also time at the end factored in, and that's important for finance element, which we'll come to in a second. So this element will sort of give you the time frame, and the reason why this time frame works in the model sort of gives you a bit of a cash flow piece as well in this. Now, what Phil was just mentioning as well, sale price, average sale in here, or however many units you're actually building here. So say this is just a single dwelling that you're building. You do need to have some good market research, and honestly, the best way you're going to do that is form some decent relationships with some real estate agents as well in the patch that you're trying to do the project, to really understand what this looks like, because there's obviously a big determining factor for a project. And so average sale per unit, you just put the sale price in. There is some impacts in this tool around how we calculate GST. I'll deal with GST a little bit later in a couple of slides, but it does do some calculations in dealing with the GST, particularly the margin scheme concept. And also you put in information around, commissions and settlement costs. That's on the sale end. Phil was also talking about sort of pre-construction costs, etc. as well. These are throughout the tool, and they're just a guide to get you thinking about the things that go into the project. So you'll see construction is a separate section in the tool, and that's just the bit around building it. Doesn't include all the other things around the development, which are sort of built in here as well. But the thing on the construction cost piece, and we just want to pause a little bit here because it's a bit of a cautionary element, because we're talking about you guys on the call today being builders and developers. And I really want to stress that this construction cost in here, which is essentially your building company billing the project for building the actual product on it, I want to caution you not to be dropping that number as low as possible just to make the feasibility work, because it's a double-edged sword on that one. It's probably hurting your building company, and you're making a development look better than really what it is. So there's a trade-off in this. I'm not saying that the construction cost needs to be at necessarily full tilt margin that you would charge on a sort of third-party build, but I also really don't want people putting that number in there to squeeze it just to make a FISO work. The building company still needs to be healthy. The core reason, which we will touch on a bit later, is the building company still needs to look good, particularly for finance, because the earnings in that company are counted in terms of the money that you'll be able to borrow around this.
And ultimately, I think a lot of people on this call will be wanting to build out an actual ongoing business operation around this activity. And when it comes to financiers and other parties wanting to get a read on, how these projects are traveling from a financial perspective, they want to see real numbers in play. And so it is just this, it's another one of these balancing acts that you've got to kind of keep in mind in terms of running a proper FISO over whether these things are going to work or not. So we might move on now to, I guess there's a whole host, and we should probably say as well, this is a fairly simple feasibility tool. Some of these feasibility tools that we get exposed to in the market are page after page after page, as they should be. This is a really good tool for people who are just wanting to sort of get a quick read on whether a project is worth having a deeper look at. And I think that's probably the best way to be looking at this kind of tool, Josh. Yeah.
Yeah, correct. This is somewhat of a back of the coaster style to just go, look, does some high level scratching, does it make sense out of the gates? If it does look like it largely makes sense, then you should definitely be spending a lot more time going through all the elements of it. So it has some items in here that not necessarily exhaustive list. It's just things to think about in terms of those sort of pre-construction or cost to the development as well. And you'll see in here as well, the model's built so that it naturally takes into account an assumption that you're going to claim all the GST as well through this, which is actually in a couple of slides' time. But the bit that we want to focus a bit on is the next one around the finance costs, and really what we're getting at with this element, because at the very end of today's presentation, we'll talk you through what some of the funding options look like and what they sort of mean in terms of cost. But what you'll get out of today, I hope, is that really it's not around just core cost of debt. It's actually what the debt enables you to do is actually where we're going to get to today. And one of the key things I want everyone to park in their mind quickly is, what is the actual return on your capital employed to a project? That's actually the key metric to be measuring. if you've had to put up X, what's my return on that money? And the funding will actually help sort of understand that as well. So with this sort of funding, it sort of gives you a quick high level. A lot of sort of non-bank funding, which actually is quite heavily used in this space, does actually lend based on a sort of percentage of your gross realization value, or basically what you're selling the property for. A lot of them actually lend on that. A number of them also lend on total development cost, a percentage of that. But what the tool does, really high level, is it just tries to give you an idea of how much money you're going to have to put in yourself into the project to make the funding and the project work. Now, I've put this down the bottom here, things like interest rates, etc. Now, that's a bit of a broad spread rate. If you can get away with doing sort of more home style lending for your project, you'll be in the sort of 6 and 7s. But if you have to go up into sort of private funding, you could be 10s, 11s. So you're just going to be really mindful of what that means. Now, and I can tell you now, in a lot of cases, the projects do make sense by taking the 11% private funding money, because actually typically it means you've had to put less down and you can get the project done quicker. So we'll talk through that. But that's sort of bit I want to let you guys marinate through the rest of this this webinar today, to just think about it a bit differently. We're not just going to a bank and getting standard funding anymore to do this.
And that, that's a simplified kind of picture there in terms of interest rate. Obviously, if you've got multiple lenders involved, then, there's going to be, a mix of rates applied as they come in and out of the facility. So this tool, there's some instructions built into it. You'll get a copy of that when we email out the video from today. And again, if you're not doing a feasibility calculation at all, then at least use this one, and certainly use this one as a way to gauge an initial sort of sense of whether a project is investable or not. And it's a good option then to sort of drill down further from a FISO perspective, using your finance people, using legal people, and of course a good accountant. We're just going to do a quick sidebar here on the GST margin scheme, which is a bit of a mind bender. So we might just roll it through like this, Josh.
Yeah, that's fine. We got 20 minutes in, guys, and I hadn't talked much about tax, so I thought we did pretty good. Okay, GST margin scheme. The reason why this sidebar is so incredibly important is, even to this day, it can actually be tripped over pretty badly, as we've sort of seen in practice. Plenty of times it comes up, and sometimes it's pretty tricky to understand why it exists in the first place. Now, looking at property development, the key framing around this is when you're building a new property, there's this concept of creating new residential premises in our GC system. And when you create new residential stock, it's subject to GST. And so it's taxable event when you sell it. But there is a mechanism in our system that recognizes, a lot of the time, this is not always the case, but a lot of the time, when you bought the land in the first place, you didn't have GST in it. So you didn't claim GST when you originally bought the land. Now, would you believe there's something in our tax system that's actually kind to you around GST, in that we're not just going to slog you with 1/11th of your sale price. Like ordinary sales as a building company, you sell something, 1/11th of that is GST. When you're playing in property development, this margin scheme metric comes in to sort of go, well, that's only charged GST on actually what you've made from buying it to selling it. From a GST perspective, that's ignoring income tax for a minute, just because it recognises that $1 million in this example never had GST in it. So you never got the benefit of claiming any GST.
And this is, like you bought it off, the land came off mom and pop. It was, more of a retail play. There wasn't GST wasn't involved in the initial transaction.
Yeah. Now, I want to point out that box says, it's simple, one or purchase price. That box in itself, in the sort of timeline of events, is actually one of the ones that gets us unstuck with margin scheme. Like, you really need to understand when you're buying the land, who you're buying it from. Is that person that actually you're buying it from, were they actually had to pay GST themselves? Because it might knock you out of margin scheme. So one of those things where you have to be very careful front end and at the end when you sell it from the margin scheme, because things do need to line up in the right sort of way. So looking at this example, we've got, a 3.3 sale price, a 1 mil.
Bought the land for $1 million, did the development. It's now 3.3 sale price.
Yeah. So we've got a scenario there. Actually, the margin scheme step one is to actually, at settlement, there's a withholding regime that operates, and this has specifically been designed for developers, it turns out, is on settlement, if you actually tick the right boxes, so you're eligible for margin scheme, you must make sure it's applied in the contract when you sell it. And what happens at settlement is the buyer is obligated to send 7% of the sale price to the ATO at settlement. So you don't get that, it goes to the ATO. And so that's the ATO's way of sort of collecting some of the GST first, just to make sure you don't walk away from it. Step two is you actually do the calculation for the GST. And on this case, 3.3 less 1 million, we're talking about 2.2 overall here. And the actual calculation for the GST is somewhere around 210 when you use that example. But the key thing is 231 has already been withheld via settlement. So when you lodge the BAS activity statement for that period that you sold the property to report it, in this particular example, because 231's have already been paid to the ATO, you'd actually get a very minor refund in your BAS because of that. And that whole mechanism is just there to make sure that, GST is actually sent to the ATO. Unfortunately, historically, there may have been some naughty developers who used to do this, sell the property, never pay the GST, and then liquidate the development company. And so the ATO had enough of that years ago. But over that, we're going to put a withholding system in place.
So GST, Josh, fair to say, in the work that we do, this is one of the areas where people come most unstuck. And it's because of things like, whether GST was involved in the first place, it's whether the process has been followed properly throughout, even just underestimating, GST being involved at all, not being on the radar. So certainly it's one of those areas that people really need to make sure they're getting solid advice on. I'm going to move on now. I know, Josh, you love that stuff, and we could talk about that for a long, long time, but we're going to move on now to Suze, who is going to give us, I guess, the quick version. We've done some webinars on this stuff recently in terms of the tax reform agenda of the federal government at the moment. We're going to do a quick trip through this now because it is relevant, particularly the new build components. So we might just throw to you, Suze, now. Can you just walk us through just the major settings, I guess, around how capital gains tax is changing now and how that's going to impact us?
Yes, thanks, Phil. So, there is, as most people are now aware, three main areas that property is being affected following the budget announcements, and we do have legislation already for the capital gains and the negative gearing. We're still, as Phil mentioned at the start, waiting on some legislation around the trust side, and Josh will touch on that a little bit later as well. But talking about capital gains for a minute, it will start from 1 July 2027, so we're fast approaching that. I remember when we first started talking about this, we said, we've got a year or so, we're fine, we've got stacks of time, but we're fast approaching it now, tail end of August. It'll be upon us in no time. So what that means is the CGT discount is going to be replaced at 1 July 27 with the new indexation method. There is some crossover that will apply. So the discount will apply up until 1 July 27 and then indexation kicks in after that. But we're not going to we'll go through an example shortly about how that works. New builds will retain the eligibility for the 50% discount, and we'll touch on this in a minute, but the definition of new build is critical for how that will apply and when it will apply. As I mentioned, indexation will come in. The 30% minimum tax on real post-indexation gain will also kick in. That means that from 1 July 27 and following, we will be hit with a minimum 30% tax on a capital gain. So we do have to factor that in as well. It will apply to all CGT assets. So this is not just a property-based issue. This applies to everything: shares, property, managed funds, and even is now including any pre-capital gains assets, or those pre-1985 assets that have always been excluded under the CGT regime. These will now come into play for gains that have been incurred after 1 July 27. So it's important to realise that if you do hold any of those assets. Critical as well to know, small business CGT concessions are preserved. So if you are selling a business or a business asset, it's definitely worth getting advice as to whether the small business concessions may apply to you, because that can really reduce your gain way back to almost nothing in a lot of cases. There is an automatic cost-based reset that will kick in at 30 June 2027. Under the legislation, they are deeming that any asset we hold at 30 June will be effectively sold and reacquired within that period. So at 30 June 27, you're deemed to sell it and you're deemed to reacquire it, which means a valuation will be needed. And whether we get a valuation at 30 June or we push it a little bit to closer to the time of sale, that's something to discuss with an advisor. A lot of people don't need to run out and get it straight away, but it would be critical to kind of consider, do we need to do it sooner than later in terms of getting valuations in play? We're going to kick in and have a look at this example. Phil, you had something you wanted to just...
Oh, sorry, just had myself on mute there. Yeah, it's probably another piece of the puzzle that we'll be diving into on subsequent webinars. Just, should I get a valuation? Shouldn't I? There's a lot of sort of setting around that people need to consider so that they're giving themselves the best possible outcome down the track, in the future. But there's some broader aspects that we'll need to consider at that point. So, okay, so this is an example of how the new CGT system is going to happen, which is actually a blend of previous 50% and then the indexation method as well.
Yeah. So walking through this, we're dealing with a property here. We're saying we've purchased the property for $400,000 back in 2015. At 30 June 27, we're saying the value of that is $700. We've got our valuation. We know that it is $700. And then in August 2029, we're planning to sell this property and we're going to get $760,000 for it. So the first period, the 2025 up to 27, 30 June 27, the old rules are going to apply. So that means you can still apply the 50% discount on that gain there of $300,000. So even though you didn't sell it at 30 June 27, we've got a deemed gain that will still be contributable for the CGT discount. So at that point in time, we've not crystallised, formalised, I suppose, a taxable amount of $150,000. So $300,000 with our discount applying, $150,000. We don't pay tax at that point in time. So we've just worked out what the value is and what the actual gain would be, but we don't pay tax. Then when we sell the property in August 29, that's when we're going to pay tax. So at that point, we have to look at what we had before, the $150,000 with our discount applying, and now under the new rules, what that works out to be with indexation in play. So we've got a gain over that just over 2 years of $60,000. Indexation here, we've assumed an indexation rate. We won't know exactly what that is until that time because it will be based on CPI at that point in time. Indexation will drop that gain back a little bit because we're able to increase our cost base in line with indexation, which means our taxable amount on sale will be about $24,500. So we add together our $150,000 from our discount and our $24,500 under indexation, and we've got a total taxable amount under this example of $174,600. And it actually interestingly works out just on that 50% or just under 50%.
It's not a million miles away, is it? I mean, I think, and obviously this is going to change over time, as the 50% piece lessens in terms of the ratio of what that complexion looks like. But you can see, I guess, the design of this is that it's initially not too much of an impact, but it will it'll change over time.
100%.
So we might just move to negative gearing now. And again, sorry if we're moving through this content quickly today, guys. We do have a bit to get through, so we're gonna motor through. You can watch it back at half speed later on if you like. So negative gearing, this is the other one, Suze, when it comes to, I guess, major changes, people investing in property, etc., and obviously wanting to leverage negative gearing. There are some changes here as well.
There certainly are. So, and this is really critical in terms of dates and when you owned property. And that's going to determine, well, there's a few things here. You need to look at contract date and potentially settlement depending on what you've purchased. But basically your contract date is the one that we're going to be looking at. If you've purchased your property before the budget announcements on 12th of May 26 and it's negatively geared, that's no issue. That will continue until you sell the property. So whether that's now or whether that's in 2032, that negative gearing will continue to apply.
Well done.
The period between 12th of May 26 and 1 July 27, which is when the new rules start, is a transitional period. If you buy property in that period and you negatively gear it, you can claim negative gearing up until 1 July 27. So you get, 6 or 8 months. If you sell after that date, or the negative gearing won't apply after that, you can't claim it, but it's ring fenced. And we'll talk a little bit about that in a minute because it comes into a couple of these examples. After 1 July 27, any property that you purchase effectively means no negative gearing at all, except for any new supply that you create. And so new supply means if you had an existing property, you must make more than one going forward. So if you've got a property, you knock it down and you rebuild, and it's like for like, so one property is knocked down, one property is built, doesn't apply. You've got to create another new supply. And we have examples in a couple of other webinars we've talked about on how that will all work. And we will do more around those sorts of things as well. So as I said, applies to new builds acquired from 1 July 27. And full negative gearing on those new builds is retained. So if you do genuinely have a new build, you can keep that negative gearing, and you do get your 50% discount as well. That continues on new builds going forward.
We might just go through just quickly, what this eligibility looks like in terms of what's new and what isn't.
Yeah, excellent. So anything that's considered not new will have all the new rules apply. Anything considered new, as I just said, will have CGT discount available and negative gearing. Off the plan, if you're buying an apartment off the plan, it's new. It's considered a new build. Knock down to a duplex. So as I said before, knock down to replace with a single won't apply, but knock down to duplex or more will apply. Building on vacant land, so no residence existed in the first place and you've put something new on there, that will apply. And interestingly, if you've newly built it, occupied it for less than 12 months before the first sale, then it also potentially can apply. Now, whether you've actually had any negative gearing on that in that period, unsure. Capital gains tax discount actually won't apply anyway because it's less than 12 months that you've held it, but it's considered new build. So we'll see how that trends.
Righto. Well done. That was good. Good to peel through that. Again, we do have a full webinar on those topic areas, and it's a space that is unfolding as we learn more about it and as we approach some of these milestones in terms of the timeline. So, Suze, the other major aspect that we're going to cover now is structuring, when Josh is going to come in a minute and talk a bit about the family trust and discretionary trust component of that. But just initially, when we're thinking about, let's get back into property development mode again now. When we're thinking about doing a development, one of the key things is which entity we're going to do it in. Like, what's the group structure we're going to have in play, and what are the reasons that we want to do that? So what's driving that decision making?
Yeah, exactly. So we've got quite a few different things that come into play in relation to that. Your feasibility obviously is a critical part of it, but as Phil said, structuring is critical as well. I know we've got quite a broad audience here today, so a lot of you won't be impacted by QBCC, but you do have regulatory rules in most states around building and construction. Those rules could impact what you're doing in terms of structuring as well. And certainly in Queensland, QBCC does play a big part in how we look at structuring and what we do with things. Tax minimisation plays a part as well. We obviously want to pay as little tax as we possibly have to, and feasibility, good advisors, all of those things come into play to work out what is going to be the best structure to help minimise the tax, maximise my output on the project that I'm undertaking. Not to be overshadowed, though, by asset protection, succession planning and things like that. Asset protection is critical. You want to make sure that your business assets are protected separate to your development assets that are separate to your personal assets. And so structuring becomes critical in working through those things to make sure that everything is protected along the way, not just for you and your wealth, but for your children, grandchildren and so forth as you go through life.
And it's a recurring theme, I guess, that we've got throughout, which is, you're going to have your existing business trading away, and we're going to try and use that business to be able to fund and, I guess, underwrite to a certain extent the activity we've got happening from a property development perspective, but not have this contagion around, the property development activity start to impact my actual trading business or my personal assets as well, which would be disastrous. So this is an example now of, as we've very simplistically called, a bad structure when it comes to doing development. So I've got my trading entity here. We've just said QBCC trading. This could be my Victorian or New South Wales trading entity. I've got that happening up here. It's owned by the shareholder is a spouse, and then we've got another spouse off to the side here. And the idea here, I guess, is that I'm trading both, with my clients here, and I'm running developments out of this entity as well. So just real quick, why is this not a good idea?
Look, for so many reasons, Phil, but really quickly, the main big one is when you've got your business assets mixed in with your development assets, if something goes wrong on any of those sides, all of those assets are at risk. All of those assets are potentially exposed. If a creditor was to come at you, or some insurance won't cover an incident that happens, suddenly your development activity, your development site can be sold alongside the business assets, and you've lost everything effectively. So it's very, very quick to see. Probably not best to mix them all in the same trading entity.
And you've got all of that activity mixed into one as well. So it's very hard to see, like we're in the commercial side of our advisory business, they're all about understanding margins and how you can improve those margins. If you've got all that activity mixed into one entity, it becomes harder again to be able to see what the performance looks like. So this is something that we see more often when it comes to structuring for a better outcome on each of those sort of, I guess, drivers that we spoke about at the beginning of this section too. So talk me through this structure as an alternative.
Yeah, so what we've got here is we're looking at our trading entity sits as a separate company. We introduce what we call a holding company in there. So the holding company owns the shares in the building company. We can then leverage profits coming out of the building company into the holding company to lend across to a development entity, or to push profits through to the family and get cash out into the family environment, and keep it separate in terms of family assets and personal assets in that way as well. So you can see we can move profits across, we can utilise all of that that's sitting there, but we can utilise other structures and other mechanisms to be able to keep those assets all very individual and separate across the entirety of your wealth portfolio. So
if we were drawing on this picture right now, we would say, okay, we've got a family trust here that's being distributed to from our holding company. We could be, though, sending profits out of the holding company off to the side into other development entities. So we'd be setting up separate companies off to the side, so that those separate SPVs, if you will, are engaging in the activity, the property development activity. And then once they're finished, we can close them out, and there's some protection that comes from that. There's a lot of stuff to talk through when it comes to, I guess, what still is ongoing in terms of the risk that prevail after you close that company down. But certainly that's a much better structure in terms of being able to minimise tax, but also the asset protection strategy that we'd be recommending as well.
And look, there are some limitations that might come into play now with trust, which Josh is going to talk about now, I think.
Yes.
And that's where this might move things slightly, but this structure by and large will probably still sit quite nicely in most family groups.
Okay, awesome. So Josh, we're going to come to you now. Biggest reforms to our tax system since GST, really. And I guess GST was something that was affected everyone, and we understand that these changes won't affect everyone in the Australian economy, but they will affect a lot of people. And I guess we certainly think, and we've been working with master builders on this from an advocacy point of view, that the impact has been underestimated in terms of the actual costs to the economy of what these reforms are going to bring about. But I'll get off my soapbox now, and maybe if you could just take us through, what are
I'll
the
save everyone from Phil launching into
what are the
this.
major things that are going to be changing when it comes to how tax is going to be treated within the frame of discretionary trusts?
Yeah, and so obviously the federal budget has diminished our trust in trusts quite quickly. Unfortunately, we're still in a situation, the question was asked earlier, where we actually don't have legislation in front of us to help us understand what they're actually doing. We're expecting that sometime in the next few months. But let's just sort of talk through, what's the proposal look like, and sort of how does that tie into your structuring decision. Now, I will also agree with Suze on doesn't necessarily mean that structuring is all of a sudden completely different now in a group. Trusts still do have a place, but we just need to think more strategically around how we incorporate them into our structures, and if there's any other strategies that we are employing as well. So looking at the core part to it, really high level, is trusts. In the previous example, you'll see you can stream income out of a trust, broad range of beneficiaries at different sort of tax rates. Some people at low tax rates, some people, over the 30%. But what these provisions are bringing in is a minimum 30% tax from 1 July 28 from a trust. So any income coming out of a trust, we're taxing it at 30% minimum. Now, the mechanism, we're still getting some details around the mechanism, but broadly that means the trustee gets an assessment for 30%, they pay the money, the distribution goes to the beneficiary, say the individual, and that credit, there's a credit rather for the 30% paid for the trustee that goes into the individual return, right? So at a minimum, there's going to be 30%. Now, it doesn't mean that it's flat 30%. I just want to be clear here. It's not just it's 30%, it's minimum 30%. So if your overall tax rate is more than 30%, then you still need to pay the marginal tax rate. So you're at 40% marginal tax rate. So you're still going to pay the 40, but you'll get a credit for the 30. So you'll just have to pay the 10.
And they might have been only at 26% out of the trust, but now it'll be 30% minimum.
Right.
Yeah.
And so, interesting question, Jeff. I'm about to answer this. No double taxation? Well, there is a little bit in certain circumstances, but I'll give you an example in a minute. There were some caveats. So the tranches for this were being, revised. There's a lot of, communication coming out around this. Obviously, there was a lot of doubt around what happened with testamentary trusts because the announcement wasn't very well placed. They've since come out and reframed that to go, no, testamentary trusts will be excluded from that. SMSFs are out of that as well. And there will be some carve-outs from what we can understand for primary production, but we're largely not playing in that space. The core strategy for why we use trust was the income splitting. It just means that income splitting is still possible. It just, the tax benefits that you get from it might just be reduced. Now, if you're already as a group paying 25, 30% as a group on average, you might find that this change doesn't impact you as much. However, it will change where you're using a bucket company. Now, there's a few pathways, and we'll talk through this in a minute. Like, you either stay where you are and cop extra tax. Do we restructure to a company, or this concept of fixed trust, which I'm not going to unpack today? The federal government, this is the key point, and this is where Phil and I are spending a bit of time with the Master Builders National guys in advocacy, is the federal government said there's a restructure window from 1 July 27 to 30 June 2030 to restructure out of a trust. That's a federal level, and so they're going to give you income tax relief. But standing here today, we're looking at all the other states. The key thing that makes this restructure window fall apart a little bit is every state has a concept of stamp duty, and the states aren't necessarily on board with the federal government restructure window, and we'll unpack that in a minute. But go back into the example, Phil, and just visualize what this impact is, and we'll start here. So one of the core things, so down the bottom of this picture, you can see two spouses getting profit distributions. Well, in a lot of cases, a number of groups also distribute some of that profit to an investment company, or a bucket company, as we call it, as well, as typically a distributing sort of channel. Now, at the moment, under the current rules, before this was announced, you distribute, say you've got taxable income in the trust, 400, you put some to spouse one, spouse two, this is me generalizing, and the balance to a bucket company, right? So we'd have an overall sort of position of about 27% tax, about 26%. And that has been a very common, and that common sort of structure to have. The bucket company was basically investing money and using it for projects as well. That's also very possible.
Yeah, this can be out there doing development, this can be out there doing investing in shares, all the rest of it. Yeah.
Right. And so under the new setting, though, for this proposed setting, we're actually in this scenario, and Jeff, this is coming back to your question, this is genuine double taxation under the new thing. So if we want to do that same thing again, distribute spouse one, spouse two bucket company, that 30% credit I was talking about earlier, the bucket company doesn't get it. So you have this scenario where 30% is withheld by the trustee, you still distribute it to the bucket company, and then it pays its tax at 25 or even 30% as well, depending on how that's flowing. So you could have a scenario where bucket companies tax 55 to 60% under this, which is diabolical as a concept in our head. Very nasty. And
yes.
It's
and going to be very difficult in terms of the process and decision making around how you restructure if this is your current setup. So there was a lot of good reasons to do this. The government is essentially saying, if you do this, we are going to tax you through the eyeballs.
Yep.
And really essentially try and, I guess, take this option out of the market. No one wants to be paying more tax than I guess, profit they're keeping. And so that's the outcome as it's been currently drafted. So, and again, I'm not even saying draft legislation here. We've been through a submission process. We've had some initial, I guess, look at what it's going to look like. And there's been some feedback to government. Whether they take that on board, we just don't know, and we'll have to wait and see. So not only is there the tax implications here, but as Josh said as well, there's stamp duty if you're going to restructure, and that varies around the country. And if people are trading in any of these entities, now that's not what we're showing here, but if they are, there are employment contracts, client contracts, a whole range of different things that they'll have to deal with when they restructure to a different entity. So more to come
point with the master builders is that it's just not trivial. Unfortunately, at the moment, federal MPs don't see how complex it actually is. But so that was trading in where there's profit running through a trust. But a very common strategy as well was development trust. So we're talking about property development, actually holding your development project in a trust. Again, this puts a really big sort of cloud over how we structure development in trust. Now, very Holman structure. You can see here on the left, that's just picking up that example from before that penalised. And so commonly, we've historically had development done in sort of development trusts as well, particularly where we're in a scenario where we can't do every project, but there might be a few different projects that might be on the go over the next 24 or 36 months, and you might hold some land in a development trust. Or sort of land banking is the phrase we like to use. And so if you're already in the situation where you may have land sitting there ready for a project, we've now got to make a decision to go, well, hang on a minute, do we need to actually restructure that now before these changes, or just before they kick in, or now? And really the trade-off we're looking at here is, what's the stamp duty cost to do that maneuver versus the potential 30% minimum tax that's just going to apply in the future? Now, that's a pretty hard decision to make in a lot of cases, and there's obviously a bit of assumption that needs to go into it. But basically the key message here is it needs to be looked at but it doesn't necessarily mean we're going to rush around restructuring property, because in every state in the country, stamp duty applies to real property movement and land. It'll apply every single time. So it does need to be looked at very carefully when structuring, particularly if you've already got this structure in place. Obviously, if you're about to do development and you didn't have this structure in place, Susan and I would probably approach it differently present day.
Yeah, 100%. So what I guess we're saying is this is our first read around how this stuff is going to play out, but please, we would obviously go and talk to your professionals in your camp, but we wouldn't be expecting people to be doing anything major until we actually see the final shape of this legislation.
Yeah, and that's our key. Yeah.
Just going to jump through now. Joint ventures, when it comes to doing property development, is something that you might want to consider. There's a way for those who potentially have a building company to partner with someone who has some land that they want to unlock. That is certainly a good way for people to potentially get into the game if they don't necessarily have all of the components, all the pieces of the puzzle, and they have some players in the market that they have a good relationship with. I'll underline that. It doesn't matter, though, what that relationship looks like. If things go bad, you need to make sure you've got a good contract in place. It's all the scenarios have been negotiated up front as to, what happens if this happens and how things are decided when things are put to the test. But certainly it is worth having a look at joint venturing as part of your strategy around property development.
Yeah.
And there's a whole way to kind of structure that so that you can try and minimize the risk that comes into play. A lot of that comes into how you split the arrangement and trying to have a very fair valuation of how money is going to flow through the arrangement and have all of that agreed up front. And then obviously, like I said before as well, having some serious contracts in play to protect all parties, not just yourself, but everyone else in that deal as well. And I think those deals often will stand up so much more when it comes to, being, some finance approval and others when there are good contracts in play as well. Speaking of finance, Josh, I did want to just speak to this if we could. You were talking earlier around, I guess, trying to weigh up with the property development we're doing. I guess not just from a simple point of view, what's the sale price going to be, what's the margin going to be at the end of the day, but this idea of return on invested capital. Like I've put in equity, I've put in my own money, and what's the return on that going to look like, and over what time frame? And they're often, the sort of the nuances when it comes to what a good finance deal is going to look like. Now, very clearly, we're accountants, not finance brokers, so this is outside our domain, and I will make that very clear. And you need to talk to finance people to take you through this. We're just going through the concepts, though. So, Josh, just talk us through,
I'll just go left to right
very simply. Yeah,
left to right on this really quickly is standard sort of two left panels, the two left columns there are basically ordinary lending, home lending, land and build. Now, you might look at this developer ROI line and go, well, why wouldn't I do column 2 all the time? 92%, because I only need to put in about 720 of my own equity here and borrow the rest. That's good, but you might find that you can get away with that type of lending once before the bank eventually go, hang on a minute, you're doing property development using investment debt. So the bank just eventually go, nah, don't want to do that anymore, because they don't get their money by setting you up with a 30-year loan. So then we sort of go downstream and go, you can probably get away with that home lending for a couple of times until eventually the bank goes, we don't like that anymore. Then you will sort of go into commercial bank, which is then looking at where we get our funding from. Commercial bank has to be quite specific. The LVRs aren't as high. The developer ROI tends to not be as good, but it just depends on each one, each project you're doing, the type of project you're doing. But what we see very commonly is the last two columns. And I'm going to call the last two columns the enablement funders, right? So the first 3 require servicing. They require a lot of boxes to tick to get the funding. The last 2, though, not so much. And so there's a higher cost that comes with it. So like a non-bank, it's very common. You can go up to something like 80% of total development costs. That's what TDC means. Interest rates at 7.98% aren't horrible, but there are establishment fees. So again, you're looking at this total equity requirement line in conjunction with the ROI. So how much of my own equity do I need to put in to do the development? That's the enablement piece. Because the less of your own capital you need to deploy per project, you could probably do 4 projects rather than being all on one. So you can see that the private is expensive. So proceed with incredible caution playing with private.
And there's a lot of, we don't have time today to go through it, but there's a lot of fine print when it comes to the private lending piece, and making sure that you're very aware of things like what happens if the project runs over time, those sorts of caveats that, you really need to be very aware of.
How do we deal with that, Phil? Just to give people some confidence that they don't panic, use the right brokers. So we've got proper property development and property brokers that we work with who will actually negotiate some of those terms for you rather than you trying to work it out. They'll push back. So you just got to have the right people around you, which is really a big part of what Phil's going to finish off the webinar about, is actually the right network around you to pull this off, is actually the cool bit. In terms of readiness checklist, you want me to just peel through that quickly, Phil? As well, to go, we want to do this. What do we need to have in place? So clearly there's a bit of a capability thing, particularly when you're dealing with funding from private lenders, etc. They want to see that you're able to do these types of projects. So a bit of experience and capability, seeing what prior projects look like. Clearly, you'll need to have a decent asset liability position for the group. And so making sure that that's presented well to a broker so they know how to deal with it. The obvious thing is everything up to date, tax, etc. And doing some initial feasibility. Obviously, all the structuring stuff we've spoken about all lends into the finance readiness. The structure, if that's messy, if your structure's messy, it's really hard for brokers and finances to work out how to fund you, as well as all the details around construction, your cash flows, and where you're getting your equity from. So all those key things, rather than turning up with a blank sheet of paper, if you can have these things in place out of the gates, it makes it much easier for a broker and a lender to get an idea of how to fund your project. And so then you're just working on the gaps in the information rather than a blank sheet of paper.
Yeah, this idea, I guess, of, making a call to the finance guy and saying, I'm just about to, pick up this piece of land, quick, we want to rush it through. Well, I don't think you're going to get as good a response as if you've got all of that other stuff ready to go and you've, I guess, made the best case possible for why this arrangement needs to go ahead. But certainly, as Josh said, there are brokers and they're brokers. There are certainly people who specialise in that space. And so it's worth talking to people who actually really understand. I've just chucked up that poll for people if they do want to talk to us about any of the services that we offer that I talked about at the beginning. Then you put your hand up now through that poll so that we can give you a call and set up a time to have a chat. In terms of where to from here. The last bit I guess we wanted to just stop on before we close out is really make sure you're ready to go on this journey from a property development perspective. And the key things we're looking at here are, do you have a good team such that this is a very different business activity you're going to be taking on board now? Usually you're dealing with a client who has to deal with all of the, council, looking at plans, all of the rest of it. You're going to be doing all of that work yourself now. And so do you have a team in your building company who can make sure that your existing activity is going to travel along okay, such that you can be taking yourself out of the business, not just time-wise, but mentally often as well, to be able to take on that activity? You're going to need to have good systems in place around you so you can actually track how you're traveling financially as well, both with your existing projects and these development projects. And then finally, this external team. Whenever we get involved in this sort of activity, we are playing just our role. We've got great lawyers who are involved as well. We've got urban planners involved. Every now and then you've got to deal with real estate agents, unfortunately. And of course, the finance guys as well. So we like to work with people who understand the needs of our clients, and it is a real team effort. So you need to be thinking about that as well. Who are you going to be using to help you make sure that these projects do well for you and for your family? All right. We've gone a little bit over time. I will say we understand, as I said, we've been talking about a lot of the tax reform stuff. We'll be running a boardroom briefing on the tax reform side of things. It is an unfolding piece. Once we actually have clear legislation around the trusts component, then we'll be making sure that we've crunched all of that into actionable advice, and we'll be sending out an email so that people can sign up for that boardroom briefing. We know it's complicated. It is a difficult kind of thing to cover in a webinar, so we're going to do a longer format piece where we get people in the room. We'll have a few different people to speak to that very important topic area. Okay, that is it for today. We will be coming back out with the video in the next day or so. We'll be doing an FAQ. We'll share the tool, the feasibility tool. And of course, if you do want to talk to us about anything today, then you can find us through the website. We're always happy to take on new clients. All right. Thanks, Suze. Great contribution today. Thanks for taking us through that tax reform stuff. Josh, thanks as always for your expert knowledge when it comes to property development. I know you can speak for hours about this stuff. So you did very well to squeeze it into almost an hour. Thanks, everyone, for joining us. Hope you got something out of that, and we look forward to talking to you sometime soon. Okay, thanks, team.
Everyone.
See you later.